Thank you, guys. I'm delighted to host this panel discussion titled "Navigating the Dynamic Landscape of Real Estate Investment Through Private Debt." And although the title suggests a focus on private debt, it's hard to discuss that without touching upon real estate investment in general, and especially as we have this wonderful panel of experts with us, traveling from the US and from Europe, and also from Kuwait, of course. Unfortunately, there is no time for questions, so if you have questions, please grab us in the break, and we'll answer any questions you may have in relation to the subject we've discussed today. So let's start by looking back a little bit. We're in 2024. The past 3 years can easily be described as adjectives as turbulent, uncertain, extraordinary, and even unprecedented. Marc, let me start with you. Looking back over the past few years, what are your observations you've made with regards to corporate real estate?
Great, thank you. And thank you everyone for the invitation, Kamco and Borja Bank. Can you hear me? Yep.
Yes.
Great, thank you. Well, I think the theme of this conference is really congruent with what we've been seeing in the real estate market globally, but particularly in the United States. A lot of change, a lot of transformation. Obviously, we've all been impacted by what could be viewed as paradigm shifts in how we use real estate. We're no longer really looking at real estate simply as sectors like multifamily, office, or industrial, et cetera. We really look at how we use it. So for example, live, that includes multifamily, single-family rentals, that includes student housing. When you think about manage, that includes industrial outdoor space, including truck terminals, et cetera. And then when you come to innovate, that's where it gets a little more interesting, again, congruent with some of the themes around education and where innovation hubs are located, but those include data centers, life sciences, et cetera. Then work. Work, obviously, office and medical office, that's gone through a significant transformation. But then you also just look at what we call secure and procure. So industrial, for example, and retail, that falls into how we use or how we secure and procure. So we've been looking at really how do we use real estate, really in terms of determining where to invest. But I think what we're seeing over the next few years relative to what's transpired in the last few years is really a wave of debt maturities that's really against the backdrop of repricing, essentially, both in terms of the appraisal market, but also what we call spot transaction markets. And you do that against the backdrop of what we heard earlier today, which was, I think, 76 of the 195 countries are going through an election in which every single voter has the right to cast a ballot. So not only will interest rate policy be at the forefront, but tax and fiscal policy will also be at the forefront. So when we look at the opportunities today relative to what's transpired, we think many of the huge opportunities across the globe, but particularly in the United States, are in the real estate credit market as we look to recapitalize broken capital structures and also fund what we call developments and other new opportunities.
Thank you. And just if you can touch upon how you see the change, for example, looking at offices. We're all working in offices, and I think the experience here in the Gulf has been quite different to what we've seen in the US. What have you seen on the office side and working in office?
Yep, so what we're seeing in the United States is a lot more acute on the negative side than what we're seeing in Europe as well as in Asia Pacific, where we've seen what we call higher utilization rate, meaning the employees of the tenants are occupying or going back to the office. In the United States, but it's helpful to put it into context, there's about 4.8 billion square feet of what we call existing inventory. Only 10% of that, plus or minus, is what we call Class A stock. That Class A stock has been generating or been the benefit of what we call positive net absorption, about 160 million square feet relative to that 4.8 billion. All the rest has been what we call negative absorption. So demand has been waning. What we call Class B or non-Class A stock or second and third generation stock, that's been facing the most significant challenges. But again, the Class A stock is only 10% of the existing inventory. That means the other 90% has to get repriced. But we're beginning to see green shoots in the office space. And what I mean by that is big leases are coming back into demand as opposed to small leases. We're also seeing such a wide differential in terms of rents between what we call Class B and Class A, almost 100% rent differential. So those tenants who need to make an economic decision now face a real decision to make in terms of going to Class A, paying almost 80 and 100% more, or paying something significantly cheaper. That being said, we've seen space requirements go down anywhere from 15 to 25%. I think we are close to the trough of that. Many of the leases that were created or executed over a decade ago are renewing and also going through, again, the space reduction requirements that we've seen. We think we'll go through that phase another 2 or 3 years, and then what we call the operating market for office should start to stabilize.
Cool, thank you. Borja, just turning to you now, and just similarly to my initial question to Marc, in terms of how you look at the European real estate market now, 3 years on from the pandemic starting in 2020. What are your thoughts on that?
Thank you, and thank you for having me. Pleasure to be here. The way I kind of try to think about it in my head is trying to separate assets from liabilities within the real estate and who is acting for what reasons, no? And try to frame it that way to try to understand what has happened, of the drastic change that has happened in real estate, no? So Marc pointed out basically that if you think about it from an asset perspective, there's been a drastic shift in terms of how we use real estate and for what purposes, no? Living has been a sector, obviously, that has radically transformed and is transforming itself from student housing to senior living, etc. Data centers obviously were here before the pandemic, but have exploded in terms of the megawatts or data needed for artificial intelligence and other means. And then we have the flip side, which is obviously offices, retails, etc. Obviously, these trends had started before COVID, but COVID has drastically accentuated. Obviously, real estate is very say locally driven, so it's very hard to generalize, but in general terms, that's what has happened in the asset side. So basically, some assets have been able to transfer the inflation increase into the rents. Obviously, offices created it's one good example, but many others have not. That basically means that their cap rate has not increased as it should, and that basically means from an asset perspective, it's less valuable, given that the cash flow that it's throwing is less valuable. No? From the liability side, you have the perfect storm, no? In terms of higher inflation, and then that higher inflation, which some assets couldn't transfer into increasing price, but that higher inflation was translated into higher rates. No? Think of real estate as an asset with a very long duration. No? We're talking before of 100-year bonds. No? Well, real estate is kind of like a very long duration asset. No? And hence, if you increase the interest rates and you decrease basically the expected cash flows that you're going to receive through the present value of that increase in rates, it obviously translates into a negative, say, asset value. No? And then on top of the liability side, add to that what Marc was referring to, which is the wall of refinancings that has happened, but it is expected to happen over the next following years. No? In Europe alone, we have around, depending on who you ask, no, there is around 100 billion of refinancings per year, which compared to the States is a drop in the ocean, but for the European market is massive. No? And this adds to the third, say, variable that I was referring to, which is the actors within real estate. No? And the actors have drastically changed. Not so much on the equity, that has changed somewhat, but especially on the debt side. No? We've seen the problems of the regional banks in the United States with real estate. We've seen how many banks in Europe are retrenching, and we're faced with a situation in Europe whereby there's a massive amount of refinancings, but commercial banks are hardly lending. And that leaves a very nice space for the alternative lenders.
Thank you, and we're going to come back to that point. But let me ask you, given that you work for a bank, your thoughts on the health of the European corporate real estate lenders at the moment, because we're seeing a few articles coming out of the US and also more recently on Europe about some concern with regards to some of these banks having high exposure to real estate.
Definitely. First of all, I do work for a bank ultimately, but I do work in the asset management side, so it's a bit different. But having said that, what we've seen not only from our bank, but for many other banks, as I was saying, is basically a retrenching. Basically, they will only finance those assets that are core plus, with very stable cash flows and hardly any refurbishment or construction risk, if anything at all. No, obviously on the residential side that's different because that's seen as lending to an individual buying a property, but on the commercial side, obviously a severe drastic change in terms of the risk appetite. No, I don't think. Personally, obviously, that's a personal view, but we'll have to see how 2024 and 2025 develops. That the commercial banks in Europe have had the severity and the problems of the regional banks in the States. That may be also because, as Marc was pointing out, the crisis in the real estate sector, especially, for example, offices in San Francisco and some other places, has been extremely severe. And to be honest, in Europe, obviously, there have been some areas of a lot of severity, but they haven't been as big as the ones in the US, I would say, in general.
Yes, so as an example, in the United States, we have $2.5 trillion US dollars of debt maturities over the next few years. But when you look at the bank market share of money center banks, regional banks, et cetera, it's been historically about 40% of the market. We expect that to stabilize right around 25 to 30%. That's congruent with what we saw with CMBS pre-GFC or the pre-Great Financial Crisis, where that was right around 30 to 35%, but is dropping to right around 10 to 15%. Due to the regulatory changes, including Basel 5.0, we expect that the banks to actually be a little tighter or more tight with the balance sheet lending in the context of real estate over the next few years. So there's going to be a huge funding gap, against a backdrop of lower valuation. So that's going to create huge opportunities, I think, in what we call the private real estate credit market. When you look at Asia Pacific, to put into balance to your question, getting away from banks, what we call private equity assets to private credit, it's about 31 times. So 31 times AUM for private equity relative to private credit. In the United States, that's about 5 times, and in Europe, that's about 4 times. So there's still huge opportunity in terms of market share for what we call private credit, and specifically private real estate credit, to gain in terms of compared to conduit lenders as well as bank lenders.
Thank you. Mohammad, turning to you, what's the perspective been? We've heard now about how we've seen it in the US and Europe, but in the GCC, what has the perspective been relative to what we've just heard in terms of what's happened in the other parts of the world post-COVID?
Oh, sure. Okay. مساكم الله بالخير. I'd like to first thank Marc and Borja for being with us here. Hassan, to your point, I think that the investors that we have in this part of the world and the competition that is being formed currently in the region compared to what is available in terms of opportunities in the US and the UK. Prior to COVID, prior to 2020, there was ample of opportunity and capital to be deployed internationally. I think since then, there is a lot more that is happening in the region, specifically more so in GCC, and to drill down even more into Saudi, I think there are enough opportunities that would attract investors into the market. That's one, but the other thing, given the high interest rate environment that we have been going through, there is another competition from the local banks and the local deposits that can offer attractive returns given in comparison to what we used to offer at what real estate used to offer prior to 2020. All that being said, but there is still opportunity that is in the international market and the mature market in the form in Europe and the US. And the correlation between what the investors and currencies in the GCC given to the dollar, that also makes it continue to make it attractive for investors to continue deploying cash deploying capital into these markets.
Cool, thank you. And we'll come back to some of those deposits and the way forward, perhaps as well. Now, Borja, obviously the theme of this discussion is private debt, and it's been a very much talked about subject amongst investors and very popular. Why do you think that is? And secondly, where do you see, coming back to your earlier point, where do you see the opportunities in 2024 and 25 in this space?
Sure, thanks. Well, in general, with increasing rates, the relative value of private credit or credit in general vis-a-vis equities has obviously shifted. No? When you had interest rates that were zero, negative, or close to zero, obviously having a debt instrument that paid 2 to 3%, wasn't that attractive. If you would try to make equity investments that taking favorable terms of that debt, we're able to get, say, double-digit returns. No, so it made a lot of sense prior to COVID, call it, to be on the equity side and on the debt side. That has shifted somewhat. The reason for that is, if you think about it from a company perspective, many instruments on the debt side pay significantly more than the expected equity returns, not only the dividend yield, but also in terms of overall returns. That is, also affecting the real estate market, as we said before. Think about it this way. You can do many private credit transactions in the real estate, whether it's Europe, the States, or other areas, where you can get high single digits for senior secure financing. The cap rates, i.e. the implied yield that property is paying, is still maybe on the 4 to 6%. So you're getting, say, for 50 to 60% loan to value, rates of anything of, almost double what the cap rate, i.e. what the asset is yielding. So you're basically absorbing through the senior secure financing all basically the yield that the asset is producing, okay? That basically means that the debt has significantly more value than the equity in general terms, no? When we look into the debt, obviously we are very much focused as well on sectors that have positive inflation. As we said before, you need to be, I think, in real estate on those sectors or in those niche areas that are able to transfer to the clients positive inflation. That we look at it into the debt side, but we also look at it into the equity side, as I guess we'll comment later on.
And in the context of the opportunities that we're seeing and the opportunities that you're seeing in the market today and you expect to see over the next 12 months, say, how does a falling interest rate environment affect that, and to what extent?
It's an opportunity, no? Definitely in the same way that higher interest rates affected negatively the asset value of real estate because of the duration of the asset. In a similar way, falling interest rates should affect positively, no? That's why trying to lock in right now financings with protections in terms of the refinancing risk that you're having is something very interesting, no? We're looking into some transactions just to, obviously on a no-name basis, but to mention some. We're looking into, for example, mezzanine financings on data centers where you're taking construction risk, but that construction risk is fully covered by, a turnkey contract with a proper construction company with, very big market cap, which have triple net lease agreements with the likes of Amazon, Meta, Alphabet, etc. And you're getting, low teens return for that type of investment. Yeah. That investment is not going to be there for a long time. That will be refinanced, say, in 3-4 years' time. What you need to ensure is that you lock in a certain number of years at that rate in order to ensure that, the money multiple, i.e. the full effort that you made for that investment pays off, the transaction cost and basically working hard to find the transaction. No?
Thank you. Marc, we have spoken earlier, and you've been quite positive about 2024, and you specifically referred to the opportunity to disrupt the market. Can you elaborate on that a little bit?
Yep. Maybe by example. We're pretty positive in 2023 too, not just 24. In fact, I think we were one of the most active investors in 2023, and one of those examples is a construction mezz deal where we worked with Kamco as a partner. Again, an example of disintermediating what we see in the office space. So Chicago, which is arguably a tale of two cities. You have the Central Loop and East Loop among the weakest submarkets in the country. But then you have Fulton Market, which is arguably statistically the hottest office market in the country, the hottest residential market in the country, and the hottest retail in the country. All the statistics suggest that it is so. That being said, it's a capital markets play. That there's been a freeze in the capital markets. many development sites for office and retail in the Fulton market area, but they can't get capitalized. But as I mentioned, the Class A stock in general, particularly in Chicago, is 10% or less of the office space. And it's about 95 to 100% leased or occupied as well. So there really is no inventory for those tenants who want to move to Class A office. So the thesis that we had was to capitalize what we felt is actually the best corner in all of Fulton market with a new developer, or with a developer and a sponsor that is pretty well known across the globe in terms of the equity financing. So it was a huge opportunity to capitalize what was what we call a shorter or thinner senior stack cut off at 37% and have a mezz stack roughly right around 75% cut off or detachment point. With economics where the current pay is 10% plus current yield and a total return of 17 to 18% gross returns. You can't really get that in the equity market today because, as I mentioned, we're still facing valuation declines. And I think the most important thing to note is by cutting off at 75%, you're at 2016 cost basis or development basis. So the question is, do we think there's any real basis risk through the mezz? Our answer is no. We don't think it's going back to 2016 trading prices or development basis. Maybe it goes back to 2019 at worst, but today we're proud to say that we're about 3 or 4 months from being nearly 100% leased based on the recent activity and conversation. So again, in a span of 6 months, as opposed to taking 3 to 4 years to lease up a new development for office, we're close to being fully leased in a span of 6 to 9 months at worst, simply because there's no inventory for Class A. And it's at fantastic returns that you can't really duplicate in the equity market, as Jorge noted. And then the other example is that we recapitalized a $1.2 billion industrial deal with a preeminent developer operator. I wouldn't say he or they were distressed, but they were stressed. Again, an opportunity to take advantage of what we call a sector with great secular demand through 2040 plus, and we structure that as what we call hard pref. So not quite debt, but what we call preferred equity. And again, total returns in the low 20s and a pref return of, call it mid-teens as well. So another example of the opportunities that are out there today because of the wave of debt maturities against higher rates and a general repricing in the U.S. market.
Thank you. And Mohammad, in terms of, and I know that Kamco is actively pursuing opportunities both in the equity and the debt space on real estate. But from your point of view, what do you see being the biggest challenge from an investor's point of view in the GCC to tapping into these opportunities? And how are you managing to create a pathway for these investors?
Yeah, sure. I just want to also just mention also one thing about what Marc said and the opportunity in Fulton market. It is something that we are definitely, we believe in, and we definitely see the value of office, Class A office in areas like the US and Europe and the UK. In this part of the world, and you go east towards Asia and the rest, the work from home mentality or environment is not really prevalent as opposed to the US and the UK. But offices, Class A offices with the right amenities and in the right locations, they will always find occupiers. Which we have seen and experienced in the Fulton market that Marc has the opportunity that Marc has talked about, and we're very happy and glad to hear that they're almost done in terms of the leasing. So
is that new information?
Yeah. So that's fantastic news for us and for our investors. But to your point, Hassan, and the challenges that we have seen, that we are as a company operating in Kuwait and out of the GCC. Our client base are mainly in the GCC area. There are opportunities that are competing opportunities and investment instruments that are available in the market that compete with such returns that we can that can be generated in the U.S. or European markets. To the point of the earlier panel, our colleague Abdullah was talking about fixed income instruments and bond and sukuks that have been very active, and Kamco has been very active in it in the 2022 and 2023. And these are opportunities and instruments that our clients appreciate, and the investors in this part of the world appreciate and understand, because there is that element of liquidity in it that generates the good returns. There is the cash flow that comes with it, the predictable cash flow, which prior to 2020 and prior to the pandemic, real estate opportunities used to offer in the equity side. Generous return, decent return, generous returns, and with predictable liquidity. Now, fast forward to today, and what the market has shifted into opportunities in the debt space. The debt space is something that we at Kamco have been looking at for quite some time, since 2014 and 15. But at that time, where at the level of interest rate at that time did not generate enough or decent returns that would attract investors, because there were the good returns in the equity side. Now, in today's environment, we think that the debt can generate very good returns as high as the equity used to be, assuming a debt risk, which is a lower risk to the equity. So there is that segue, and that is that entry point into this market. And also to Borja's point, there is a short window depending on how long and when do we think interest rate will start to go down, and how will that impact the credit space. But there are good opportunities right now into that space that would generate returns, but we need to seize the opportunity, because that window will be shut in the next 12 to 18 months, where things will turn around.
And from your point of view, do you, when you look at debt opportunities, do you have a preference whether they are operating assets, i.e. hospitality or student housing, or is there a preference towards long let product or development, or is that less important for you?
Right now, I think from what we've seen, there are sectors that we definitely are interested in. One of the hottest sectors are, to Borja's points, also is data centers. It is something very important that we can see, and we see that the long-term value creation that can happen there. But when it comes to other sectors, we're agnostic. We look at the opportunity. If it makes sense, we will definitely we'll look into it and drill down, and we'll definitely consider it.
And Borja, if I may ask you a similar question, from your point of view, as pursuing these opportunities in Europe, do you look at that aspect and what are the things that are key for you when you're assessing these deals?
So I fully agree with what Mohammad said, but I mean, on the debt side, we're much more opportunistic. So we may go into a situation or into an asset that may not be the one that I would buy from an equity perspective, but from a credit perspective, it does offer the security, the yield, the return, and also the likely exit, because when we lend, the last thing we want to do is to do a loan-to-own type of transaction and end up, enforcing and having to sell the asset. So the exit on a debt perspective, it is fundamental, So when you take all of that combined, on the debt side, we're seeing that opportunities not only on the, say, data centers or living sector, but also on the offices, retail, commercial centers, etc., that are very, very interesting. When we look into the equity side, we are much more focused on where we see a lot of value being created and a lot of opportunities, and there our focus is mainly on the living sector. So there's been a drastic change in the way living concept is happening in Europe, but especially in Southern Europe. The demographics around it are basically ones that the numbers, to the extent that we start looking a bit more into, say, the UK or the US, are increases of growth of more than 10, 20% even per year. So if you think about, for example, student housing, in Spain, there's only 7% of beds per student in Spain vis-a-vis in the UK, that it's around 30%, whereas Spain is a country that attracts a lot of students because of our history with universities and openness and what have you. So it is natural to think, and there's many projections, many studies, that number will significantly increase. No? So if you can capture that from an equity perspective, whilst not absorbing a lot of risk, you are likely to enter into a sector that is growing, that is booming, and are able to enter into, say, equity or asset yields, of around, almost 10% when you build the residence, and you can probably exit around 4 to 5%, and that with that yield compression on the exit is how you make, say, high teens returns. So that's the expectation.
Thank you. I think we're coming to the end of it. Thank you very much, panelists, for participating, and thank you very much, audience, for listening. As I said, if you have questions, please tap us up during the break and enjoy the rest of the conference.
Thank you.